Good day, everyone. Welcome to the second lecture of our course, Accounting and Finance for Managers. Today, we are diving into one of the most practical and indispensable areas of accounting, the analysis and interpretation of financial statements and cash flow. Whether you're steering a company, managing a department, or providing guidance to investors and clients, your ability to analyze financial data is a skill that can significantly impact decision-making and business success. Let's begin by exploring the four foundational financial statements that every manager must understand to effectively assess a company's financial health and performance. These documents are like the pillars of a building, each supporting a different aspect of financial insight. 1. Key financial statements. The balance sheet. The balance sheet serves as a snapshot of a company's financial standing at a specific point in time. Think of it as a photograph that captures everything the company owns, assets, owes, liabilities, and the net worth left for its owners, equity. This is summarized in the fundamental accounting equation, assets plus liabilities plus equity. A robust balance sheet reflects financial stability and resilience. As managers, you must critically evaluate whether the company is over-leveraged, relying too heavily on debt, undercapitalized, lacking sufficient funding to sustain operations, or maintaining healthy reserves to weather uncertainties. For example, if liabilities far outweigh assets, the company may face challenges meeting its obligations, which could lead to financial distress. Conversely, a strong equity position signals that the business is well capitalized and capable of reinvesting in growth. The income statement, profit and loss statement. Unlike the balance sheet, which provides a static view, the income statement tells the story of a company's performance over a specific period, be it a month, quarter, or year. It details revenues earned, expenses incurred, and the resulting net profit or loss. This document answers critical questions such as: is the company generating sufficient revenue to cover its costs? Are operational processes efficient enough to drive profitability? For instance, a rising net profit margin over several periods indicates improved efficiency or cost control, while declining profits may signal operational inefficiencies or market challenges. The statement of cash flows. Profitability alone doesn't guarantee survival. Many companies fail not because they lack profit, but because they struggle with cash flow. The statement of cash flows tracks the actual movement of cash in and out of the business, categorized into three main activities. 1. Operating activities, cash generated from core business operations. 2. Investing activities, cash spent on or earned from investments such as purchasing equipment or selling assets. 3. Financing activities, cash flows related to borrowing, repaying debt, or issuing dividends. This statement helps answer crucial questions. Are we generating enough cash from daily operations to sustain the business? Are we wisely allocating resources for growth, or are we over-investing in non-essential areas? How are we funding our expansion, through debt, equity, or internal cash reserves? The statement of changes in equity. Lastly, the statement of changes in equity tracks movements in shareholders' equity, including retained earnings, dividends paid, and new shares issued. While this may seem more relevant for corporate reporting, it's vital for managers to understand how business decisions, such as declaring dividends or raising capital, impact the value created for owners. For example, frequent share issuances might dilute ownership, while consistent dividend payments signal financial strength and shareholder commitment. Footnote: disclosures. Let's turn to an often overlooked yet critical component of financial reporting: footnotes and disclosures. These are the fine print of financial statements, providing the context and assumptions behind the numbers. Without them, financial statements are just raw data, numbers without a story. Footnotes reveal important details such as the accounting methods used, e.g., depreciation policies or inventory valuation techniques. Contingent liabilities such as pending lawsuits or guarantees which could have significant future implications. Assumptions made in asset valuations like estimating the useful life of equipment or projecting future cash flows. For example, two companies might report identical revenues, but footnotes could expose that one is using aggressive revenue recognition practices, inflating its performance. Similarly, a pending lawsuit disclosed in the notes might indicate a substantial financial risk. As managers, reading these notes equips you with deeper insights into potential risks, opportunities, and the overall quality of the financial data. This is especially critical in industries with complex financial structures, such as construction, where long-term contracts impact revenue recognition, software, where deferred revenue is common, or pharmaceuticals, where R&D expenditures and regulatory risks play a significant role. Key takeaway: never interpret financial statements at face value. Always examine the accompanying footnotes to uncover the full picture. 3. Financial ratio analysis. To make sense of raw financial data, managers rely on financial ratios, powerful tools that transform numbers into actionable insights. Let's categorize these ratios into 4 key groups. Profitability ratios. These ratios measure how effectively a company generates profit relative to its revenue, assets, or equity. Examples include gross profit margin, indicates the percentage of revenue remaining after covering production costs. Net profit margin reflects the overall profitability after all expenses. Return on assets, ROA, shows how efficiently assets are used to generate profits. Return on equity, ROE, highlights the return generated for shareholders. For instance, a high ROE suggests that the company is effectively utilizing shareholders' investments, while a declining net profit margin might prompt managers to investigate rising costs or pricing pressures. Liquidity ratios. These ratios assess a company's ability to meet short-term obligations. Key examples include current ratio compares current assets to current liabilities. A ratio below 1 may signal liquidity challenges. Quick ratio, a stricter measure that excludes inventory from current assets. Liquidity issues can disrupt operations, damage supplier relationships, and even lead to bankruptcy. Monitoring these ratios ensures the business maintains adequate cash flow to operate smoothly. Activity ratios, efficiency ratios. These ratios evaluate how efficiently the company uses its assets. Examples include inventory. Turnover measures how quickly inventory is sold. Low turnover might indicate overstocking or slow-moving products. Accounts receivable turnover assesses how efficiently the company collects payments from customers. Asset turnover ratio reflects how effectively total assets generate revenue. For example, if receivables turnover is low, it may suggest lax credit policies or inefficient collection processes, directly impacting cash flow. Leverage ratios. These ratios measure the degree of financial risk by analyzing a company's reliance on debt. Key metrics include debt to equity ratio, compares total debt to shareholders' equity. Interest coverage ratio indicates the company's ability to cover interest expenses with operating income. While moderate leverage can fuel growth, excessive debt increases vulnerability during economic downturns. Managers must strike a balance between leveraging opportunities and managing financial risk. 4. Common size and trend analysis techniques. Finally, let's discuss two essential techniques to deepen your financial analysis. Common size analysis. In this approach, every line item on the income statement is expressed as a percentage of total sales, and every item on the balance sheet is expressed as a percentage of total assets. This standardization allows for meaningful comparisons across companies of different sizes or over time. For example, if marketing expenses consistently rise as a percentage of sales, managers might investigate whether this increase is driving proportional revenue growth or eroding profitability. Trend analysis. Trend analysis examines financial performance over multiple periods to identify patterns. Are revenues growing steadily? Is the profit margin improving or shrinking? Are debts increasing disproportionately to assets? By identifying trends, managers can forecast future performance, anticipate challenges, and make proactive adjustments. Conclusion in summary. Analyzing and interpreting financial statements is not just about reading numbers. It's about uncovering the story behind them. Here are the key takeaways from today's session. The 4 core financial statements provide a comprehensive view of a company's financial position and performance. Footnotes and disclosures offer critical context, revealing risks and assumptions that numbers alone cannot convey. Financial ratios translate raw data into actionable insights, helping managers evaluate profitability, liquidity, efficiency, and financial risk. Common size and trend analysis techniques enable meaningful comparisons and long-term strategic planning. As managers in today's dynamic business environment, mastering these skills will empower you to make informed decisions, drive improvements, and create lasting value for your organization. In our next lecture, we'll put these concepts into practice by analyzing real-world financial reports and case studies. Thank you for your attention, and remember, financial literacy is a powerful tool. Keep honing your skills.